what remarkable feat are we talking about here? Like, mostly nothing's changed. The economy is so much bigger than the particular policies of a president. The typical outperformers are gold and commodities, and the typical underperformers are bonds in particular.
Yeah.
And when you look at how most portfolios are positioned, they're basically all in on bonds and hold no gold and commodities.
Is the tech trade finally fading? We're going to talk about what's next for the entire stock market, gold, commodities, what investors should do now, and this software stock crisis that's seemingly popping up out of nowhere. Bob Elliott joins us. He's the founder of Unlimited, previously ex-Bridgewater executive and trader. Welcome back to the show, Bob. Good to see you.
Thanks so much for having me, David.
I want to start by talking about IBM, and we're not focusing on one stock. I'm not picking on IBM. I'm just using this as an example. It's down about 30% in the last couple of weeks, okay? Now, it's down 13% just a few days ago. In one day, just on the news that Anthropic had released a new AI agent that could read COBOL codes. For context, compiling COBOL codes and managing them is a significant part of IBM's business. Apparently, the market thinks as 13% of their business, whether it actually is up for discussion. Is this an overreaction, or perhaps not even fully factoring in what this rise of AI agents could mean for all software and hardware companies, not just IBM? Is this the beginning of several different Ciscos now, Bob?
Well, I think from a macro perspective, which is typically how I'm viewing the market, rather than at the individual name level, this sort of software scare, I think it's a little confusing to folks who are looking at the individual stocks and then trying to extrapolate that for the whole market. When you think about software is a B2B business predominantly. Mm-hmm. And what those businesses are doing is they essentially take profits from real economy businesses. And so if you think about the overall profits that are available in the economy, the trade-off between real economy and software is basically who gets to absorb the profits, who gets their share of the profits. To the extent that we have tools that basically make it more available for real economy companies to be able to create their own software, essentially wean themselves off of institutional software, they will accrue more profits. And so at the aggregate level, actually the pie continues to grow just fine. And really all the conversation is about who exactly takes what share of the pie. If anything, the pie grows faster to the extent that we can be more productive in creating software in aggregate for the economy. And so these sorts of things are unambiguously beneficial for the overall economy, even though there's going to be some losers like IBM, and then there's going to be some winners across the real economy. And you're seeing that in the stock market. It's not just sort of it's not just a flows rotation, it's a fundamentals rotation that's reflective of the fact software companies are leeches to real economy businesses, and they're being disruptive, and that's a good thing for the real economy.
As an investor, aren't you just concerned that the entire sector is at risk of being cannibalized by themselves? I mean, Silicon Valley startups are producing AI agents that could basically replace other legacy companies' tools and tasks. And so going back to my statement, they're basically cannibalizing on each other. We don't know what's next to be cannibalized. So as an investor, I would think to myself, why don't I just short the entire sector? Do you agree with that logic or no?
I mean, I don't have a particularly strong view on whether the software companies are actually going to be beneficiaries from the AI agents. There's lots of reasons why you might argue that they should be the primary beneficiaries because they're the most capable, or whether real economy companies are going to be most benefited from these agents. What I do know is that two important things, which is one, to the extent that agents in general make everyone involved in the economy more productive, that's likely to lead to better incomes and better profits over time. And number two is that to the extent that, you know, a real economy company can make themselves more efficient and wean themselves off, that's good for their profits. And so that's what that's what you should focus on.
Well, you know who doesn't agree with that view, Bob, is the writers of this particular report from Citrini Research that's been circulating online over the last couple of days. The 2028 Global Intelligence Crisis is the name of this particular Substack. And the first line is, what if our AI bullishness continues to be right, and what if that's actually bearish? And then it's making a prediction by 2028, the unemployment rate will hit 10%. Traders would have grown numb. And basically, let me just summarize what this report is trying to discuss here. AI gets better, firms cut white-collar payroll, margins rise, savings get reinvested into AI computing power. It gets better even still. There's more layoffs to come, and the result is an economy where headline output and productivity can look strong while household income and spending weakens. So productivity skyrockets, but actual living standards plummet. Can you just comment on maybe the logic here? Do you agree, disagree?
Well, I think it does highlight the sort of this macro story when it comes to AI-oriented productivity, is that what you cannot have a combination of widening margins and continued top line growth, because very simply, the people who are employed in the economy are the ones who are earning the income who are doing the spending. And so I think that is for the uber bulls related to AI, where they just think, oh, companies are just going to have, incredible margins, and then that's it. Like, they're going to be wildly profitable and stocks are going to surge. They are missing that point. And I think part of what the Citrini report does is it brings that concept to the table. I think that the challenge with that is that you're going to have a circumstance. It's much more likely, I should say, that the AI-related activities increase the productivity of the overall economy, which lifts all incomes, much more than it is likely to somehow suppress overall incomes as a result. Because to the extent that you can implement these technologies, to the extent that workers can implement these technologies, they're more productive. You actually see that in some of the early data, like the St. Louis Fed data around worker productivity related to AI. You're generally not seeing much labor loss. You're seeing productivity enhancement. And so they're able to do more things than they were able to do before. That should translate to higher incomes than they were able to do before. For instance, we're actually seeing that in the real economy lately in terms of, labor force growth, mostly because of constrained supply. Labor growth has been relatively modest, but we've had pretty strong overall economic output. That's a good thing. That's now flowing through. We're starting to see some pickup actually in wages. So job leavers are actually starting to get compensated. That sort of flattened out and started to rise again. And so I think it's much, much more likely that we have a virtuous upward cycle driven by increased productivity related to AI than somehow we're going to have some existential crisis, the way it's described in that piece. That's going to, create widespread unemployment.
Before we continue with the video, let's talk about today's sponsor, Delete Me. Now, most people don't realize how much of their personal information is publicly available. Data brokers collect and sell details like your name, address, phone number, and even family connections. That's why I use Delete Me. It helps reduce that exposure. It takes just a few minutes to set up, and then they do all the work. They scan for where your information appears, verify those listings, and submit removal requests to hundreds of data broker sites. They also keep monitoring over time, since this information can resurface. I've been using it for over a year, and they have reviewed over 325 listings for my information. The reports show exactly what was found and what was removed, which makes the process transparent. Go to joindeleteme.com/David Lin, link down below, or scan the QR code here, and use my promo code DavidLin for 20% off of all consumer plans. Now, back to the video. Okay, let me play for you a clip of Trump's speech from last night. He made a State of the Union address, one of the longest he's ever made. Take a listen to this clip.
Our nation is back, bigger, better, richer, and stronger than ever before. I used these tariffs, took in hundreds of billions of dollars to make great deals for our country, both economically and on a national security basis. Almost all countries and corporations want to keep the deal that they already made, right, Scott? Knowing that the legal power that I, as president, have to make a new deal could be far worse for them, and therefore they will continue to work along the same successful path that we had negotiated before the Supreme Court's unfortunate involvement.
You're aware that the Supreme Court struck down most of Trump's tariffs. Okay, last weekend, what do you make of his earlier remarks in the beginning of the clip where we're entering a turnaround for the ages for the economy here?
The big picture is not much has changed in this administration relative to the previous one. Real GDP in 2025 was a touch softer than it was in 2024. Labor markets from an unemployment perspective have largely been flat. Stock market's up a little bit. It was rising a little more rapidly in the previous administration. The dollar is largely in line with where it's been over the course of the last couple of years. Same with bond markets, bond yields. So, what remarkable feat are we talking about here? Like, mostly nothing's changed. And part of the reason why that is because the economy is so much bigger than the particular policies of a president. Meaning, like, the macroeconomic dynamics that are at play. Of course, the Fed can nudge it in one direction, or presidential policy can nudge it in another direction. But the big picture story is it's like a freight ship that just continues to plug away, and the weather matters a lot more than the tugboat pushing it in one direction or the other.
What is gold signaling right now? It's at $5,200. And in the State of the Union address, Trump reiterated that Iran poses a risk not just in terms of the ongoing nuclear deal that may or may not be reached. We'll still see it's still ongoing, but also that Iran has developed or is in the process of developing long-range missiles that can hit the U.S. He said this seemingly as justification for possibly a strike that's coming up. And now you said previously to me in the past interview that gold has shown some frothiness. Do you still maintain that view now that we still have escalating geopolitical tensions in the Middle East?
Yeah, so gold's gone through a couple periods of financial sector manias, both in the fall of last year as well as in January, and these sorts of things happen often when you have a more secular uptrend in terms of an asset. And so the question when you're thinking about that is you have to get into the flows and to sort of understand who's buying and selling in order to see whether you're starting to see sort of those frothy elements. And post the sort of spike up to 5,500 that we saw in January and the move down afterwards, we've seen a real normalization of the flows picture. So ETF flows, whether it be in China or the US, are actually pretty subdued. Central bank flows are relatively modest, continuing along, but nothing particularly extreme there. Positions in the derivatives market look quite subdued as well for money managers. And so you look at all of that together, and what I see in the short to medium term is, an all clear to get back into the gold trade. Said that, a couple $100 ago, and it's largely playing out. And instead, what we're going to see is the sort of continued march higher and higher in gold as you see more Western investors add it to their portfolio. That's creating a squeeze on the overall supply demand. But that there's nothing that has occurred over the course of the last couple of months that has really changed that picture. And along the way, you're going to sort of see wiggles and manias and collapses around it, but not anything that really challenges that ongoing trend.
Is there a war trade for you, Bob? I'm not saying a strike on Iran is going to happen. We don't know yet, but we do know that the current military buildup around Iran and in the Middle East is the largest since the Iraq invasion of 2003.
Yeah, so something like trading the war trade specifically, I don't think that I have a particularly non-consensus view. The things that you're describing are well known in the media. I think in general that most investors are radically underweight war-related assets or assets that perform well in war environments. And look, if there is a meaningful conflict, I don't know if there will be or not, the typical outperformers are gold and commodities, and the typical underperformers are bonds in particular.
Yeah.
And when you look at how most portfolios are positioned, they're basically all in on bonds and hold no gold and commodities. And so, in that sense, I'm sort of consistently say to you need to be more strategically overweight war than you currently are in your portfolio. Whether that pays out in this particular moment or not, I don't have a particularly strong non-consensus view relative to what's currently priced in the market. So I will say that being long gold and oil over the course of the last couple of months has actually, has been quite a good trade to be in.
The 60/40 portfolio is back, says the CNBC report, and actually beating the S&P 500 year to date. Going back to your comments about bonds, can you comment on this and whether or not holding bonds and perhaps overweighting treasuries would continue to be a good idea for the remainder of the year, Bob?
Well, I mean, 60/40 is basically flat since the beginning of the year, and what a snoozer it is. And I think most U.S. and Western-based investors are constantly looking at the S&P 500. And my God, have there been way better opportunities that are out there? Like foreign stocks, emerging market stocks have crushed the S&P 500 since the beginning of the year. Gold and other commodities have crushed the S&P 500 since the beginning of the year. And what it's highlighted is the way to be winning right now is to be looking outside of, relying on only U.S. financial assets as a way to generate returns. If you've been in a world where you've been properly diversified on a global basis, you've been crushing it. And if you've been myopic about the U.S. only being the only source of returns, it hasn't worked out for you particularly well.
Well, this goes to Unlimited's strategy. So you've got a 50/30/20 portfolio. Tell us about that, how that's different from the 60/40.
Well, I think what we see is investors are moving from a traditional 60/40 to a 50/30/20, where about 20% of their portfolios are in what I call alternative strategies, meaning strategies that can go long and short a wide range of different assets in order to generate positive returns in different market environments. And you just see it since the beginning of the year. Our strategies are not solely focused on holding U.S. stocks or U.S. bonds, and because they've been able to go globally in terms of global equity markets, stock, bond markets, commodities, currencies, they've been able to generate meaningfully positive returns in an environment where traditional U.S. asset holders are just kind of putzing along here at a zero return.
The logic behind alternative assets being part of your portfolio, I mean, why not just go all in stocks, for example, if we were to reduce the holding of bonds?
Well, I think in general that you don't want to be concentrated in one particular set of economic outcomes, and so part of the challenge that most investors have is they're basically long only. Maybe they're long only stocks, maybe they're long bonds, maybe they buy some odds and ends like private credit or private equity or venture capital. Those are all long only strategies, and what they rely on is that assets have to keep going up, and in particular, U.S. assets have to keep going up. And part of the idea of bringing alternative strategies into your portfolio is to create diversification of, say, alternative assets or alternative strategies. And so if you're going to continue to be long only, you need to be adding gold or commodities to your portfolio because that creates clear diversification relative to stocks and bonds. But even better is to add those strategies that can be long and short, because sometimes markets go up and sometimes they don't. And so the question is, do you have strategies in your portfolio that can win, that can add value in markets where assets are going down and when assets are going up? And so if you think about something very simple like global macro, the best two periods for global macro in the post GFC period have been in the last 6 months and in 2022. Radically different economic environments, but if you have the flexibility to go anywhere and go long and short, you can make money in a wide range of environments.
Okay, well, can you just give us a few short theses or ideas, without, you don't have to name particular securities if you don't like, but some of the themes that you may want to be short on.
Well, I think when you look across the world, the dollar is continues to be quite elevated. I think a lot of folks are focused on, like, it moved a fair amount in a short time frame. Moved 5 or 10%, depending on how you measure it, last year. But from a longer term secular perspective, the dollar is basically just off its highs, and typically it takes declines of 25 or 30% from this point to start to create a bottom in the dollar. And when we look across the world, we look at big institutional managers and investors, they're all going through a process of de-dollarization in one form or another. It's a sort of process that takes 10 or 15 years to play out. And part of the reason why you've had such strength in global asset markets is because those foreign investors, instead of putting every incremental dollar into U.S. stocks, they're starting to put it into their own markets that are more cheaply valued. And so that's a place where I think it's very compelling. Now you have to pick what you're doing. You don't want to necessarily go short the dollar relative to the yen, which is in a structural negative environment. But there's certain economies that are particularly strong, like, for instance, the Australian economy and Aussie dollars, that are in a much better position economically. I mean, they're in an actual tightening cycle, whereas the U.S. continues to be in an easing cycle. And that's where you want to sort of pick your position on the dollar.
Well, for U.S. investors, their U.S. stocks are denominated in U.S. dollars. So if we're going to be bearish in the dollar, would it not be simpler to simply invest in overseas securities? How do you feel about non-U.S. denominated assets and equities?
I think there's a lot of great opportunity, and we sort of started with the software story, and I think a lot of folks are really focused on, like, is ChatGPT and OpenAI going to win, or Anthropic, or whatever? Are those specific ones going to win, or how are they going to affect U.S. companies? But, like, what is clear is that there is going to be a radical investment in compute capacity, data centers, et cetera. And so you don't have to know which model is going to win to know that the people who are providing the picks and shovels to those companies in that investment are going to be winners. If you look across the emerging markets, there's lots of great opportunity. I mean, you just look at places like, for instance, in the Korean economy, you've had incredible earnings growth. You still have low PEs, far lower than what you're seeing across much of the developed world. Those are the sorts of places you want to be, where there's a much more reliable sense that they're going to benefit from this AI boom than trying to pick winners and losers in the United States.
Yes. The crypto space facing a lot of headwinds rather. Bitcoin's down about 50%. Is there a place for crypto in your alternative allocation of 30% of your portfolio right now?
Yeah, I mean, you could certainly dabble in crypto. I think when you're thinking about those alternative assets or strategies, you really want to be thinking about things about whether things are meaningfully complementary and diversifying to your strategies. And so, Bitcoin certainly has a lot of beta to risk assets. It's sort of the leading edge of liquidity and risk taking, and so it's a little less diversifying if you look back through time than something like gold. But it's not zero diversifying, and I could certainly see a reason why you might want to have it in your portfolio. I think the key challenge with a lot of these assets that are more sentiment-oriented assets is varying your position to take advantage, particularly of the bull runs, and be able to be flexible to move back when sentiment starts to shift against them.
I want to finish up by talking about your own trading and research experiences, starting with prior to Unlimited, you spent more than a decade at Bridgewater Associates, head of Ray Dalio's investment team, also on the investment committee. Just tell us about some of the biggest lessons you've learned at then and now one of the world's largest fund managers, and how you're applying it to your own ventures today.
Well, I think probably two things that in my mind come up when I'm thinking about the key lessons learned. The first is the real benefit of of applying a systematic approach. I think part of what people underway in the asset management business is it's a head game. Um, and what that means is like lots of people have created approaches that over time will generate differentiated returns or alpha. But the question is, can you actually stay the course through the volatility and the noise that exists in the markets? And part of the way to do that is to be systematic. Now, you don't have to build, a massive technology infrastructure the way we did at the world's largest hedge fund, but even just writing down the rules of why you're doing what you're doing and what your game plan is, and then sticking to it is really critical in terms of you know getting your edge, using your edge as much as you possibly can. So that's a sort of one key point. The other key point I'd say is humility, which is not something you hear a lot in the industry. But if you've been around, if you talk to an old grizzled trader, they will uh, they will go on and on about all the bad trades that they've made in their career. And part of the reason why that is the markets have humbled them. And I think we went through a process over a couple of years where basically it was like just buy anything that's going up and buy the riskiest stuff you possibly can, and you'll do really well. And that's created a lot of overconfidence from particularly investors early in their career. And so just having some humility, recognizing that, uh, you know, if you've done well, it may or may not continue. If you have a view, you may or may not be right. And if you have a portfolio, you want to consider a wide range of different outcomes is really critical. And so when I think about what we're doing in Unlimited, we've basically built a systematic approach to understand how a wide range of different hedge fund managers are positioned in real time, and use that for our products. And part of the reason why we pursue it that way, essentially alpha indexing is kind of the way I would think about it, is having the humility to say what my personal views aren't necessarily the only approach that can generate alpha. If anything, actually, the wisdom of the crowd may be smarter than any one manager's views.
Well, you've been vocal about fees in the fund management industry, and in fact, you're trying to eliminate or reduce fees. Just tell us about that and what you're trying to do here at Unlimited.
Yeah, the big problem, one of the biggest problems in the alternative strategies space and alternative asset space is that the fees are too high. It's just all there is to it. And so managers get rich and clients aren't much better off than they would be on their own. And so the question is, how do you bring concepts of diversified low cost indexing, which has had a huge benefit for the everyday investor in areas like stocks and bonds, and bring it into the world of 2 and 20? Because look, hedge fund strategies, if you pay rack rate fees, aren't worth anything. They're not worth including in your portfolio. But if you can get access to the same sort of alpha at a quarter of the fees or a tenth, or even as much as a tenth of the fees, well, then that's a much more compelling strategy that you can include in your portfolio. And so that's what we're really focused on.
Yeah. And final question, just out of curiosity here. Ray Dalio has been on social media, not recently, but over the last several months to couple recent years, warning us about the changing world order. He's even written a book, Principles of Dealing with the Changing World Order, and he's rather bearish on world developments, and even at one point saying that we could return to the gold standard. Has Bridgewater always been on the more cautious side, or is this a more recent development here? I mean, I know Ray is not directly involved anymore, but when you were there with him, is that has he always been kind of this gloomy on the world?
Yeah, I think you go back and you can look at his writings and his media over the course of the last couple of decades, and I think folks who have done that see real patterns of similar commentary through all sorts of different environments, sort of continuously saying the same basic line of thinking. And what you've seen recently is largely consistent with that. And what I'd emphasize is like, look, reading about, uh, you know, reading doomer takes about the end of the Western civilization, like, might be nice entertainment, but it's not going to do shit for you for trading markets. So I would just not spend your time waste your time looking at that stuff. Like,
Well, how would you translate that into an investment thesis if you had to? I mean, is that something that could be done? Is that basically it's invest elsewhere besides the U.S.? I mean, is that practical, investment strategy here?
Well, I don't think it's a particularly useful line of thinking if you're trying to
Yeah.
develop alpha strategies over a time frame that most investors care about. I think
Right.
probably what it highlights more generally, I'd say, is that it's important for investors from a strategic perspective to think about a wide range of different outcomes, that what's being proposed in that writing is one of many possible outcomes that could exist. And so asking yourself, seriously about whether or not your portfolio is sufficiently diversified to a wide range of outcomes. And I think the answer is most portfolios, particularly in the US, are not. They're mostly all in on US exceptionalism, whether it be, US equity markets or US bond markets. And that may well continue for the next 250 years, the way it has in the past 250 years, or it may not. And so, if you're going to build a long-term strategic portfolio, you should have things like foreign assets, foreign stocks. You should be holding gold. You should be holding commodities, all of which essentially are hedges to the sole success of the United States.
All right. Thanks very much, Bob. Good to hear from you once more. Where can we follow your work?
Yeah, for sure. Folks who want to find my work, you can find me on all the socials, generally under Bobby Unlimited is the handle. You can check me out on Substack. I write a daily newsletter called Non-Consensus. And if you want to learn more about our products at Unlimited, check out unlimitedetfs.com.
We'll put the links down below. So check out Unlimited. And Bob there, thanks a lot. Bob, take care for now. We'll see you soon.
Thanks so much for having me.
Thank you for watching. Don't forget to like, subscribe.